What I have for you this week is not our usual case law study, but I think something that people are interested in as well, and that is Pillar 2. And what I want to do is actually go through the articles to see how they apply in practice. So let's get going. Just as an introduction, here is a table of contents of Pillar 2. You see Article 1 or Chapter 1 deals with the scope of the GLOBE rules, which is the global base erosion rules. Chapter 2 talks about the charging provisions. In other words, who pays the top-up tax. 3 tells you how you calculate the low tax income of per jurisdiction, how you calculate the taxes, and once you have the taxes and you've got the income, you can calculate the effective tax rate, and that's dealt with in 5. And then we move on to special topics. We talk about corporate restructurings and holding structures, tax neutrality, the admin of all of this, transition rules for the startup of the GLOBE rules, and then 15 pages of definitions, which is quite a lot on about 40 pages of legislation. I will focus primarily on the left-hand side of the screen. So we talk about the base provisions, and what is striking is, even in basic scenarios, how very quickly things get quite complicated. So let's dive into this and see what happens. We're going to have a very base scenario. We have 3 countries where we've got a 20% tax rate, a 5% tax rate, and a 25% tax rate, and we've got a parent company in the top. We've got OpCo in the 25% country, and FinCo or Financial Co in the bottom, and there's interest payments going from OpCo to FinCo. Now, if we look at the OpCo's numbers, then we see it has an EBIT of 200, but then it deducts 100 in interest payments, so it ends up with an earnings before tax of 100 and tax of 25. And FinCo has an EBIT of 0, it has interest income of 100, it has an EBT of 100, and it pays tax of 5. So how do we get to the top-up tax that parents should be paying under Pillar 2 for FinCo's income? Well, first of all, we'll work our way to the top-up tax, but the top-up tax, for knowing what the top-up tax is, you need to know what the effective tax rate is, you need to know what the minimum tax rate is. To know what the effective tax rate is, you need to know what the taxable income is, and that's what we're working our way through to the bottom of the calculation. So FinCo's global income is defined in Article 311, and it says the global income or loss of a constituent entity is the financial accounting net income or loss for the fiscal year, adjusted for all kinds of things. So we're talking about FinCo's financial accounts, and in the next paragraph or article, they talk about the group accounts where possible to use FinCo's accounts as used in the group accounts to do those calculations. And now we need to calculate what FinCo's adjusted covered taxes are. This is the definition term that they use. They say the adjusted covered taxes of a constituent entity shall be equal to the current tax expense with respect to the covered taxes adjusted by. And then our current tax expense here is 5. We keep things simple. And then we say what is the FinCo effective tax rate, and that's defined in Article 511. And it says the effective tax rate for a jurisdiction is equal to the sum of the adjusted covered taxes of each constituent entity. So if there are more than one, you've got to add them up, and we'll do that in a bit, divided by the net global income, again, of each individual entity, and that's 5 divided by 100, which is 5%. And now we need to figure out what the top-up tax percentage is, right, which eventually will have to be paid by parent. And the top-up tax percentage is the positive percentage point difference computed in accordance with the following formula. You take the top-up tax percentage is the minimum rate minus the effective rate. Now, I've already calculated the effective rate, that's 5%. The minimum rate is defined in Article 10.1.1, and it says the minimum rate means 15%, basically, also written in words in the formal definition. And then 15 minus 5 is 10%, so the top-up tax percentage is 10. And then the top-up tax will then be defined in Article 523, and it says the jurisdictional top-up tax is the top-up tax percentage, which we know is 10%, times the excess profit, and in our case for FinCo, the excess profit was just assumed to be the full 100. So the FinCo top-up tax is 10, and now parent has to pay this 10. So let's see how that happens. Parent co application of the income inclusion rule. So we assume that parent co is an income inclusion rule country, and then Article 211 says the ultimate parent entity that owns an ownership interest in a low tax constituent entity shall pay a tax equal to its allocable share of the top-up tax. And now the question is, what is the allocable share of the top-up tax? And it says here, a parent's entity's allocable share of the top-up tax of a low tax constituent entity is the top-up tax of the low tax constituent entity multiplied by the parent entity's inclusion ratio. Now, since our parent entity owns 100% of FinCo, that will be 100%. So the top-up tax will be 10, which is the top-up tax that we calculated on the previous slide, multiplied by 100%, and that is 10. So ParentCo has to pay 10. A lot of text for coming to a relatively simple formula, but things will not stay that way. Let us go a little further and see what happens if ParentCo does not have an income inclusion rule. Now we fall back to the under tax payments rule, right? And now OpCo gets to apply the additional tax, and then we see how OpCo does it, because there is quite a significant difference, and that is 241 says constituent entities shall be denied a deduction or required to make an equivalent adjustment in an amount resulting in an additional cash tax expense equal to the UTPR top-up tax, right? So the deduction must be so big that you make up for the top-up tax. Now, OpCo country and FinCo country have different tax rates, right? So you can't just use the FinCo numbers to come to the deduction denial that will be the same as the 10 that needs to be paid extra. So what you do here, the detail is in the wording, an additional cash tax expense, right? You shall be denied a deduction in an amount resulting in an additional cash tax expense. And then what 251 says is the total UTPR top-up tax amount shall be equal to the top-up tax calculated for each low tax constituent entity in accordance with Article 5.2. Now, in accordance with Article 5.2, we already know that is 10. So how do you get to the deduction denial for OpCo? You say, well, the top-up tax must be 10. The top-up tax amount must therefore be 10 divided by 25%, because that's a tax rate for OpCo, which is 40, and then you add that back to the EBT of OpCo, which then becomes 100 plus 40 is 140, and then it will end up paying, instead of 25 of tax, should be paying 35 of tax, making up for the 10 that FinCo should have paid but did not pay. So far, so good. Let us now change things a little bit and say, you know what, instead of having one parent entity, we've got two sub-parent entities, and the ultimate parent entity does not apply the income inclusion rule. So we now must have the sub-parents apply the income inclusion rule, right? The rest of our numbers stay as they are. Now let's see what the guidance of the text say. So SP1 and SP2 application of the income inclusion rule is in Article 212. It says an intermediate parent entity, which both of these are, that owns an ownership interest in a low tax constituent entity shall pay a tax equal to its allocable share of the top-up tax of that low tax constituency. So we come back to this allocable share again. And now we need to see what that is. A parent entity's allocable share, Article 221, of a top-up tax of a low tax constituent entity is the top-up tax of the low tax constituent entity multiplied by the parent entity's inclusion ratio. So it is 10 multiplied by SP1 and SP2's parent entity inclusion ratio. And the parent entity inclusion ratio is defined in Article 222, and it's a bit of a weird one. It says a parent entity's inclusion ratio is the ratio of A, the globe income of the low tax constituent entity reduced by the amount of such income attributable to ownerships held by other owners over or to the globe income of the low tax constituent. I say that this is a little bit of a weird formula because I think it's difficult to word fractions properly, right? But B, if you take your own part reduced by the attributable income of other owners, you have already calculated the other owners, in other words. And how do you calculate the other owners? You calculate them by calculating this owner, right? So there's something circular in this wording, but we know what they mean. So I think I know what they mean, and it means that if you look at SP1, its income inclusion ratio is 100 minus what the other owners own, which is 60%, right, over 100, so it is 40%. And for SP2, income inclusion ratio is 60%. Now the outcomes are pretty obvious. The question is if the wording could have been a little more simple, but I'm quite sure that the OECD must have had scenarios in mind, which I'm not covering right here. So now that we know what the income inclusion ratio is, we can say the top-up tax for SP1 is 10, which was the top-up tax due by FinCo, multiplied by 40% is 4, and for SP2 it is 6. And in that way we now know what the payments are that are due. And now the question is, how do we know that the parent co doesn't have to pay this ultimately if maybe the law changes with retroactive effect or whatever and they introduce an income inclusion rule in parent co country? And there it says in Article 213, 212 shall not apply if A, the ultimate parent of an M&E group is required to apply a qualified IIR. And what a qualified IIR is defined in Article 10.1. It means a qualified IIR means a set of rules equivalent to Article 2.1 to 2.3 of the GLOBE rules included in domestic law of a jurisdiction and that are implemented and administered in a way that is consistent with the outcomes provided for under the GLOBE rules. So if you already have an IIR in your law, so if parent co had an IIR, then 213 would have applied, and then we would say 212 about the intermediate parent entity in the top of this top right of the slide shall not apply if the ultimate parent co is required to apply a qualified IIR. But since the ultimate parent was not required to apply a qualified IIR, that's why we stay in 212, and we need to go through 221 and 222 to calculate what the income inclusion rules for the sub-holding companies in this structure are. A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses.